Welcome to the new analytics video. First of all, don't forget to leave me a like and follow, and to not miss anything, turn on the notification bell. FMA goes bullish. Today, I will explain the basics of the stock market to you. The stock market is a marketplace where people buy and sell shares of companies, called stocks. Worldwide, there are more than 80 major securities exchanges, including over 100 stock exchanges that facilitate the trading of stocks. Additionally, there are numerous commodity, futures, and currency exchanges that cover different types of trading. In total, there are over 270 organized trading venues active worldwide. The number of publicly listed companies is about 53,710, spread across all exchanges. The Asia-Pacific region leads, with around 60.7% of listed companies, followed by North America and Europe. The stock exchange serves as a central engine of the economy by channeling capital from investors to companies while ensuring efficient trading and fair conditions. Traditionally, there was open outcry trading with floor brokers. But today, digital, electronic trading platforms dominate. It facilitates trading between investors and companies, enabling capital raising and investment opportunities. In the United States, the SEC, Securities and Exchange Commission, is an independent federal agency that regulates the securities market. Its primary role is to protect investors, oversee stock exchanges and brokerage firms, and enforce securities laws. It ensures fair, transparent, and orderly markets by combating fraud and enforcing disclosure requirements on companies. When someone purchases a stock, they become a co-owner of that company and can benefit from its success. Stocks are traded on exchanges, which are organized markets with set rules. A stock's price is determined by supply and demand. When many people want to buy a stock, the price rises. When many want to sell, the price falls. Companies issue stocks to raise capital and grow. If the stock's value increases, it can be sold for more than it was bought. Additionally, some companies pay dividends, which are profit shares distributed to shareholders. Stocks are a way to build wealth and protect against inflation. This method is becoming increasingly important as our fiat currency system is based on ever-increasing debt, and real inflation is rising. As a result, the wealth of each individual shrinks, and humanity is being pushed into increasingly risky assets, forcedly. Of course, stocks also carry risks. Stock prices fluctuate significantly, so you can make both gains and losses. This volatility is the fundamental risk of stocks. For stocks of companies from other countries, currency fluctuations between the foreign currency and the home currency can cause losses. Emotional decisions driven by fear or greed can lead to disadvantageous selling or buying choices, amplifying losses. Therefore, one should never act on emotions. Additional costs can arise when buying stocks. These include order fees, the spread, the difference between the buying and selling price of a stock, custody fees, taxes, and other costs, such as withdrawal fees, or maintaining a leveraged position overnight, among others. These can vary by provider. There are numerous broker and exchange comparisons available online, so everyone must find the provider that suits them best. I exclude my personal opinions here, focusing purely on factual analyses and data to provide you with as much information as possible. If a full polished translation or further adjustment is needed, feel free to ask. Have a nice day. Cheers!